to the Smart Property Investment Show with your host, Phil Tarrant.
G'day everyone, welcome to the Smart Property Investment Show. Appreciate you tuning in. I've got a regular guest on the show. I'm going to call him a co-host because he helps me often and sometimes. He's pretty good. It's the one and only Jim Hall. Jim.
Hi Philip, how you going? Nice to be back.
Jim heads up mortgages and real estate here at Momentum Media. So I often get him on the show. Not only he's a salesman, so he can talk pretty well, but he's also a property investor. So he lends a lot of his insights in real world practicality of investing in property, but also with the mindset of running a podcast. So it's always good to have you here, mate. Our guest today, someone who is a good friend of Momentum. We've known him for quite a long time. It's Paul Glossop from Pure Property Investment. Mate, how you going?
Very well, Phil. Thanks for having me. Jim?
How you going, Paul?
Good, mate. Yourself?
Good, yeah,
Excellent.
very well.
So we had a couple of your clients, I guess you'd call them, on the show probably a couple of months ago. I think Lauren and Lena, who happy customers of yours, which is
Absolutely.
good. Those guys are doing quite well.
Number 2. They're in Italy right now as we speak on a junket for a month, enjoying their lives and feeling the fruits of a property investment portfolio that's performing.
When they come in and spoke to us, they're investing property for wealth creation, but also a bit of a lifestyle choice as well. So it gives them that flexibility, I guess, moving forward, that they like to travel and they want to do all that sort of stuff. So this is just a product of their endeavours, which is good to see.
Absolute fruits of their labour, and I think they're exactly those clients who don't want too many fancy things in life. One car, really budget well, and their desires and passions is travel, and they've managed to build a portfolio of 4 properties on very modest incomes, or I'd say average incomes, and they're happy to admit that, and they've had the ability to make sure that they're profitable and can also budget and live their lives and enjoy what they want to do as part of it. Yeah,
cool. They're a good couple. If you want to listen to them, I can't remember what, you're going to have to excuse me what podcast episodes they were, but if you just check out the bottom of the page that you listen to right now, you should be able to track them down. Lauren and Lena, really good story, those guys. I've asked Paul, so Paul's a buyer's agent, and we're advocates of buyer's agents here at Smart Property Investment Show, as we are of all other professionals that work in the space to help you not only understand the value and the benefits of investing in property, but allow you to make it happen. Myself, as a property investor, I lean on my buyer's agent, my accountant, my broker, and a number of other people to make stuff happen. So it's always good to get buyer's agents in on the show, and my objective today is to try and put Paul out of a job. I'm going to get inside his mind. I'm going to tap into all the things that you should be doing, you could do yourself, and let's learn some stuff from him. Look, for me, I'm quite privileged that I get to speak to guys like Paul and other very good buyer's agents all the time. And you know what? I could probably go out there and do it myself. But you know what? I still keep going back to buyer's agents because they get the job done and they free up time. They can do the job better than me. So you know what? If you don't want to use a buyer's agent and you want to go out there and you want to burn the shoe leather and spend your weekends tracking down property and finding hotspots, let's get into Paul's head and see if we can get some tidbits of information from him. You okay to share those?
Absolutely. And personally, I'm a massive advocate of people becoming educated and probably more enabled to do it themselves. And we like to see success stories of clients coming through, buying 1, 2, 3, potentially 4 properties and thinking, you know what, I've got time, I've got the propensity and knowledge, I'm going to go do it myself. And we still talk to those clients to say, look, is that a good idea? Yes, no. And we're happy to rebound those thoughts and queries off those clients as well. So happy to do it.
So just on that note, do you find that people will use a buyer's agent and then they might do it a couple of times themselves, then go back to using a buyer's agent? Is that quite a...
Absolutely. And I think it's probably not necessarily going from using a buyer's agent, going to it themselves and coming back. It's probably doing it themselves from the outset, figuring out things that they probably shouldn't have done, and then thinking, okay, let's assess this, and then getting on things such as Smart Property Investment Podcast, reading up the magazines, websites, all information they can see, and probably realising they haven't got the performance they initially thought they'd get, and then thinking, you know what, I'm probably not equipped enough, and nor do I have enough time to do this that's going to get me the results the right way the first time. So that's probably more the realistic scenario, rather than buyer's agent, go out, potentially not get the results after, then come back. And then the alternative is use a buyer's agent numerous times over, figure out the process, understand what we do and how we do it, and then go and employ it themselves. I mean, it fills me with joy when I see that happen and people succeed their own way.
So just empowering people, getting
Absolutely.
them on the program.
I mean, that's part of what we do. It's not to say we've got all the secrets. It's our IP. We're not going to give it to you. You just pay us a fee and we'll go do it for you, and we're never going to tell you how we've done it. Our process is hand in hand. It's hand in glove, I should say, where we give them information but try to give them as much detail along the way to say, this is why we've done it, this is who we've used to do this is what you can do next time over. So if you have the time and the inkling, go for it.
It's good. It's encouraging to hear that it's still a relatively new sector of real estate, buyer's agents. It's not as popular as it will be in the future. There's some exceptional buyer's agents around. So it's good to see the the way that you approach it is very similar to the way that my buyer's agents approach it. And I obviously speak to a lot of other guys as well who are buyer's agents, some very, very, very good operators around there. But having that mindset around empowerment of people, give them the tools, I know every buyer's agent I speak to, they want to make sure they sit there and they see people buy horrible investments and it just ruins them for years and years and years, and they can never get back onto the property ladder because they've bought the wrong property to start with. So I think the message for me out of this conversation is speak to buyer's agents. Even if you don't want to use them, pick their brains because they will share information with you because most of them are passionate about actually ensuring that you get into the right property. Jimbo, what do you use a buyer's agent?
Pretty much it's a time thing. I'm very, very time poor. I don't have the time to research particular markets, find the right property, negotiate with the agents, liaise with conveyancers, work with people if I might do a small renovation or just smarten up a place. So for me, it's purely a time thing. If I had more time on my hand, could I probably find somewhere? Yes, I probably could, given what I know and the people I have contact with on a daily basis. But even then, I'm not a professional buyer's agent. I wouldn't consider myself a professional property investor, although I invest in property. I'd rather leave it to someone who's a lot smarter and a lot more knowledgeable about investing in property than myself, and that's why I do it personally.
And you've been very successful. You've got a pretty big portfolio. You probably represent a very small part of the Australian population. That you own a sizable portfolio. And you know what? You've done it while you've had a full-time job as well, which is pretty intense. So it's impressive what you've been able to achieve. Like you, I follow a very similar strategy in terms of investing. We try and find our buyer's agents under market value property that we can look to manufacture equity in, but they're in locations which should give us both capital growth and yield over time. My question to you, find an under market value property. It's a big one.
Needle in a haystack. One thing I'd say, and that's probably, it's a question, we're working on a property right now for a client this morning, and I just got off the phone with them before I got here, and they've asked me the question, if it's that good, why don't you buy it? And my personal position on right now, I'm building a property that's part of a subdivision I'm doing, and I look at every property through that lens to say, I'll run the numbers and I'll say, if this is good enough for me, it's good enough for my clients. Is it an area that I buy? Yes. And I continue that process. How do I find under market value properties? It's via a myriad of different ways, and it's everything. First and foremost for me, it's relationships that you have within the markets that you're trying to buy. I'm not the one knocking on everyone individual's door to buy an off-market property. There are agents out there whose job is to find listings to sell property. There's people who come to those more successful agents within those areas that we've already isolated as growth areas, and they'll come to them and say, I need to sell this property for the reason that it might be a divorcee sale. The bank might have a relationship with that particular agency to say, we've got this mortgagee possession that's just come on board. We want you to take the reins and sell this property. It might be the fact that for whatever reason, the agent might not have done their job and may have listed that property at a price which they may not have seen potential subdivision opportunity, renovation opportunity below market. Another one that we see, which is one that's a little bit less, I guess, utilised, is properties which are already rental properties, rented at the moment, but are well under market rent. So therefore, someone will look at it and say, hypothetically, $330,000 property, renting at $330 a week, very average yield if you're looking at comparables around maybe the $350, $380 a week. But if you look at that property on its merits, you say, well, that's well under market value from its rent. Therefore, that price doesn't reflect it. It won't get much attention from investors. We'll go in and negotiate very hard on that type of property, because what we'll do with part of that contract was we'll say, well, we want as a special condition that current tenant, we want them to sign on to let's say a $40 increase, because that's market, but that's going to be subject to our purchase. Plus, we're going to be able to go in and buy a property that no one else is looking at because the yields look horrible on paper. But again, that's one of many ways. But ultimately, I think relationships with your agents are going to be numero uno every single time.
You make an interesting point there, and that is, people chase under market value based on its capital value rather than its yield. If you're building a property portfolio, obviously you buy for, let's go back to basics. Why do you invest in property? You invest in property because you want the thing to go up in value over time.
Absolutely.
And you want a yield to help you cover the mortgage over time so you can hold that property. It gives you the facility to be able to hold that property. Some people, if it's positive yield, you might get a bit of money in your back pocket and you can use that for doing whatever you want, holidaying in Europe, for example. But the basic fundamental and premise is you want the thing to go up in value. Now, as you build a property portfolio, you find that some of your properties will perform really well in terms of capital value. They might not perform as well in terms of their yield. And on the other side, you'll find that you get some really good yielding properties, but they might not be going up in value as fast as other properties. So if you're at a point in your property portfolio, it might be 4, 5, 6, 10 properties in, when you start looking at negative cash flow and you need to start looking at yielding properties. So in this case, going down a path of finding under market value property, as in the yield is under market, and you can skewer that property, but it's going to give you a big kicker in terms of yield. It's going to help balance out your portfolio. So it's a little bit more sophisticated, but it's a good point that you made.
Yep.
It's
I think,
good.
so I might just interject there, Phil. I remember when I was when I very first started investing in property, and I think one of the things that I remember discussing with the property buyers that I used and still do use today, often a good strategy is having pairs of properties.
Pigeon pairs, they call them.
So you might have one which is in your portfolio. It does cost you a little bit of money, but the growth in equity and the growth in the price of that property is likely to increase. And you offset that with a property that, look, price might be a bit slower, but there's a lot more cash flow there. And then the two properties together end up being pretty much a neutral position. So, and I still do that today, pay a lot of my properties off.
It's smart. It's good. So going back to market value, we spoke about how do you identify under market value, and there's a whole bunch of factors and indicators to do that. I would take from what you said, relationships is number one. And it's one of the benefits of using a buyer's agent in the gym, though, that to have all the relationships with a multitude of different real estate agents, it's impossible if you do it as a part-time
Absolutely.
thing. You want the agent to be calling you saying, hey, I've got this. Why do people typically sell property? You want to try and find distressed property. Why is property distressed? It might be debt, it might be divorce, it might be death in the family. You've got to move it fast. A buyer's agent's going to get that. But how do you establish what under market value is? What does that mean?
And that's probably the question that probably is more important than anything, is that you can say, look, asking price is $350, we picked it up for $330. Is that under market? Well, it depends. Is that $350 original listing at market value, or is that actually an agent trying to price it a little bit above to get a little bit more extra for their client, which is one of the aspects which happens all the time. What we do from a market value, once you establish a market and say this is a market we're going to look for this next property, our comparative market analysis is where we do a lot of work, and we spend a lot of time on research database to say if this property top line via our filters in our financial breakdown makes sense, then we go to say, let's do a full comparative market analysis on that property. And that document's usually a 20, 25 page document to go in and say, if I'm going to buy a 4-bedroom, 2-bath, 2-car garage on 600 square metres in this suburb on a relatively quiet street, I'm going to go into my database and I'm going to say, I want to run a filter to say within 1 kilometre, I want to see every 4-bedroom, 2-bath, 2-car garage on 600 square metres that's sold within the last 3 months. I want to go and have a look at what's on the market right now, and I want to go have a look at what's for rent right now, exactly the same types of properties. We run that filter across everything we can. If we don't get enough within that subgroup, we'll run that filter out to about 2 or 3 kilometres to see a broader scope. So once we see that, we can say, okay, if we're going to buy this property at $330 and every other property we can see is going to be a minimum of $345 and beyond that's sold within the last 3, 4, 5, 6 months, then for us we say, well, if it's in a market that's not necessarily a declining market, either a flat or growing market, we'd isolate that to say that is value every day of the week.
That's a pretty sophisticated way to do it. And I imagine you've got a lot of tools and resources to do it.
And it costs money to do that, obviously.
It costs money. But if I'm just an investor, I'm doing this by myself, I should be following a very similar process. Yeah?
And I think there's relatively simple free software out there. I mean, we all know realestate.coms and the domains of the world, they're the giants of that space. And they've become very sophisticated over the last few years to have you go tap on the sold price or the invest tab on realestate.com, for example, and you can go to a map view and have a look at everything that's sold. It might not give you a refine to say, give me a date specific, but you can go tap on that property and see, is this a similar type of property? When did it sell? What did it sell for? And you can actually go into that listing ad and it might say what the actual property specifics were, if it was renovated, unrenovated, if it was renting, if so, what it was renting for. And as a punter out there who wants to do that themselves, that's one way you can jump on straight away free databases, and their filters are outstanding. So you can get on there and do that work yourself if you do want to do it.
Let's talk about stick on market value. When you view a property, how often do you look at the market value based on what you could do to the property to elevate it to where it can be? So I'm talking about the arbitrage in what you can pay on a renovation versus the value you get out of that renovation.
Yeah, good question.
So let's have a quick chat around that. So you can look at a product as it is today. Is it under market value based on what we have right now? Okay, great. The upsides for that property, if I spend 10 grand, 20 grand, can I create 50, 60, 70, $100,000 in value? That's a pretty sophisticated way to do it. And a lot of people without a number of renovations under their belt know how to maneuver and do it cheaply. Either like the idea and they overcapitalise and they don't make the money, or they can't see the wood through the trees per se. So what's your tips to investors about realising that value, that manufacturing of equity? How do you go about that?
Probably two things you touched on there. And I've got a really easy example that we're working on or have already secured a property and they're finalising their renovations, which is a brilliant way to probably look at an easy case study of this. Is we secured a 3-bedroom, 1-bath, 1-car garage on paper, high set, post-war home it'll be about 7 weeks ago now for a client. That property was an 80% finished renovation, high set, legal downstairs, but the actual owner went bust. They couldn't finish it. So when I say 80% finished, they had a kitchen put in. They didn't finish putting the kitchen doors on. They had mudded downstairs for what they wanted to put in there for their second bathroom, as well as walled up 2 new bedrooms. All of that was ready to go, but it was incomplete. So as far as a bank valuation and a total habitable position, it was a 3-bedroom, 1-bath, 1-car garage. It was ready to be a 522. So we picked that property up, for example, I think the numbers were about $269,000 purchase price. And on paper, you compare every 311. It was on 1,000 square metres, so you compare every 311 to that property and you can say, yeah, look, in its condition, they're probably going to be getting maybe a little bit cheaper than market, couple of grand, 5, 10 on a good day. But then you go compare 1,000 square metre fully renovated, which this property would be once it's done, 522 on 1,000 square metre within a 1 kilometre radius, similar to what we talked about a couple of minutes ago. And then you say, okay, comparables there are sitting at around that 330 to 350k. Now, we knew that this property had about 20 to 25, potentially 30k if you want to go do some outside landscaping to plough back into this property. So 269 plus closing costs, let's say he takes it up to around 275, another 30k into it, we're up towards that around 310 mark all in. Revaluation, it's just going to be rented, I think, about a week from today. It's on the market right now at 380 a week. So that property is going to be getting around 7.5% gross yield, and we're going to get it revalued. And I'd say confidently we're going to get about a 20k equity valuation out of that property within, let's call it 2.5 months worth of work. There's a bit of downtime cash flow for there, but that's how we do it. We say, if we can do it, let's understand what we can do. Is it legal height, for example? Is there ability to extend out? Is there a way to maybe wall up a larger bedroom to 2 bedrooms? And then you can then compare it from a 3-bedroom to a 4-bedroom. Examples go across that way. But it's understanding the property, understanding a local council and what you can do with that property as well. So a fair bit of information, but definitely that would be the way we'd compare them.
So how did you find that property originally?
Relationships. Yeah. Phone call before the property was on the market.
You got it before the market.
Correct.
Yeah.
So property was sitting there, got a call saying, look, Paul, we've got this one coming up. They're going to have to sell it. Here's the details. Ask them to send us through a full report on the property. We go do our full checks on it. We've got definitely not, I would say, realestate.com type photos. They're taken from an iPhone so we can see warts and all what the property looks like. Get a building report to say, yeah, sure, we can see it's 80% finished, but what does that mean? Let's do a full costings of that. And we've just got an itemised, our builder that we use within that area goes in and says, look, Paul, here's probably a list of what you'd be putting into this property as far as money's concerned. Truth be told, it probably worked out to be about 7 to 10k more than that. But even still, we saw there's well and truly margin in that property at that price point.
It's good. It's very similar to a property we purchased. You can check it out on smartpropertyinvestment.com.au up in Berkeleyvale on the Central Coast of New South Wales, just north of Sydney. Exactly the same situation. It was marketed as a 2-bedroom, 1.5 bathroom property, and it was a 2-story place. So downstairs was just like an open, like it looked like a student's, lounge area. It was just a den. Yeah. It was horrible.
Yeah.
And upstairs was 2 bedrooms and had a big lounge room. What had happened over time was that someone had knocked the wall out for the 3rd bedroom to make a larger lounge room. And but RP data and the valuation and everything on it was a 2-bedroom property. Yep. So we just stuck that wall back up, turned into a 3-bedder, and fitted out downstairs. Very similar to what you said. And we had a massive amount of equity on it. Check it out on the website. But it's exactly the same situation as that. A lot of people couldn't realise or see the value that you could create through spending a few bucks to actually turn it into a different property which values differently.
Yep. And yields differently.
Yeah, yields completely differently.
Well. One thing you pointed on there is that that's not the only property that you own personally in your portfolio, but that property probably would have been the right property at that time where what you said, Jim, was a pigeon pair. That property might be, say, we've got to plough a bit of money in this, but we'll take some equity out, plus our cash flow is going to benefit. Let's look at a capital growth potential property on the side of that as well.
So what's the biggest mistake you've seen investors make? So by the time they come to you and they might have a couple of properties under their belt and they go, I'm going to start using a buyer's agent, you must see some horror stories and mistakes that people have made.
Yeah.
What's sort of your top ones?
There is a multitude of different things that I think people come unstuck on quite often. One is probably not necessarily the actual property itself, but it's bad advice on finance. And I think you guys are massive advocates of brokers, and so are we. We don't do finance in-house. We're not specialists at it, but we know a whole host of different ones, and we're more than happy to put those referrals in place to say you need to speak to this person before we look at buying property, because let's have a look at your current portfolio, how it's structured, because buying in the future, we need to undo that mess before we're going to go buy again. So that's probably first and foremost. Getting your finances right before you bother looking at property for me is number one. And then from that point onwards, it's saying, well, let's understand what your objectives are. And we use the example of Laura and Lena, who are over in Italy right now. Well, they wanted cash flow orientated properties that are going to be lower price point. They've got a bit of growth in previous properties, so they wanted to focus on some cash flow in their current. So it's understanding your objectives and what properties are going to fit within that, as well as what the finance allows you to do. They're probably my first 1 and 2 before we bother going to anything, because then it becomes really quite detailed as far as what you can afford compared to what your time frame, your horizons are, what's your appetite for risk, what's your appetite to do renovations. Do you want something that's going to be passive? Is this a SMSF investment that's going to be potentially a tax position? Is there something that you're wanting to look at that's going to be a value add or a subdivision? There is probably a laundry list from that point onwards, but finance and objectives and goals are number 1 and 2, and that should dictate what you're doing and why.
It's good advice. Hotspots. So we're going to have to start wrapping up right now, because we're sort of getting over time, but people love hotspots. Hotspots. We can write articles about them all day on smartpropertyinvestment.com.
You should have like a cricket bat with like multiple edges coming off it, and just seeing like what those edges are. Is it Queensland? Is it New South Wales?
Well, it depends who you ask.
Is it ACT? Well, exactly.
What's your view on hotspots?
Yeah, I think it's pretty consistent with a lot of probably professional investors, that if the old adage of the cab driver's talking about you should buy somewhere, you probably missed the boat. But saying that, I think if you're in it, depending on your time frame, for instance, there is a lot of rhetoric around Brisbane itself, west, north, it's performing. Is it going to do the double-digit year-on-year for 3 or 4 years as Sydney's done? Highly doubtful. But are you playing a 10, 15-year game and you're after something that's going to be consistent growth? Yeah, it's probably still an area where I say has got value within it. Hobart's starting to get some attention at the moment as well, and depending on what property type you're looking for and what your objectives are, I think there's some good opportunity and good value in Hobart personally at the moment, probably within the 10 to 20k ring of Hobart. Good yields, low vacancy rates, and only just coming out of their growth, or their flat cycle, which is probably almost 10 years long. Literally 2006 was their last time that they saw growth, and it's only just come out of that now. So they're probably number 1 and 2. Then there's pockets around ACT that we see as a bit of value, long-term, bubble along type safe investments. We're keeping a tight eye on Perth, not buying that at the moment, but I think value there in the future.
Good. Jimbo, you love a hotspot.
I don't really pay too much attention to.
You get told where to invest, don't you?
To hotspots. I ask someone that knows where those hotspots are before other people know where those hotspots are.
That's the advantage. I think for our listeners, a lot of the conversations I have with investors is that they say, I'm going to invest in this area. Can you tell me where in this area I should invest? It's probably looking at things the wrong way around. You've got to remember back to the absolute basics and fundamentals of why you invest in property. And the idea of investing in property is to create wealth over time. And I use the word over time. It's not like in 6 months or a year. If you want to start messing around with high risk, high time investments, mess around on the stock market, or if you're doing it in the property market, it's probably so risky you might, blow all your cash. So when you're investing in property, you've got to focus on the fundamentals, and that is you want to find a property that's going to go up over time regularly. And how do you find them? Well, you need to invest in places where there's population growth, there's wage growth, there's a need, there's a demand for rents, transport infrastructure, good amenities, good hospitals, all this sort of stuff. It's basic stuff, and the internet is full of all the things that you should find in your next location when you invest. Paul, that's pretty fair, isn't it? Just keep it really basic and simple. That's what you guys do.
It's all we do.
Yeah.
If you're looking for something that's going to make you money in 3 years, please don't call us. When I say make you money, there's not going to be any properties that are doubling in value in 3 years, because we've gone through a mining boom, and there's a whole bunch of people who are hurting right now who probably bought properties within areas which they were told are going to succeed, and at some stage they did. And if you bought at the top of those cycles, unfortunately there's people in there who are hurting and will hurt for some time to come. We buy very boring, and I like to say that if you want to come to us, you're going to be in the position where you'll get some sound information that's going to be very simple to understand, and it's going to perform over time.
The biggest mistake I hear from when I ever ask investors the biggest mistakes in property, there's two. Number one is they didn't buy more, or they didn't start buying early enough, or they didn't buy more when they could, is one big mistake. That's not a bad mistake, but it's more of a missed opportunity mistake. cost. The other thing is that they bought the wrong property first. So don't buy the wrong property first because it's just hamstring you.
Absolutely. And don't buy yourself out of the market.
Absolutely. Paul, mate, thanks for coming in. We'll get you back again at some point. I'd like to get some insights into the way you negotiate with agents to get the best price for property, which is a skill in itself. And buyers agents are very good at it. So, mate, appreciate your insights.
Thanks for having me.
Good to have you here. Jimbo, thanks again, mate.
Thanks very much, Phil. Yeah, thanks, Paul.
Cheers, Jim.
Remember to check out smartpropertyinvestment.com.au. We're on all the social pages. You can follow me on Twitter at Philip Tarrant. Please keep the reviews coming on iTunes. 5 stars are the best, but please leave a comment. If there's anything you want to hear from us, any questions, leave some remarks there, or you can email me at editor@smartpropertyinvestment.com.au. Thanks for tuning in. We'll see you next week. Bye-bye.